At the beginning of 2024, investors were intently focused on the implications of possible election outcomes in South Africa. Post-election, it seems like some of the worst-case scenarios have been avoided. But what does this mean for investors in their fixed income portfolios specifically? Joining me today to unpack this issue is Lyle Sankar, Head of Fixed Income at PSG Asset Management. So Lyle, I think to kick us off, can you unpack some of the lessons that you took out of the recent local elections?
Yeah, thanks Adri for having me. Yeah, I think there's lots of lessons to be learned when looking back at the elections, but I mean obviously we all breathe a sigh of relief that the outcome was very positive, markets are very happy, and we've seen the bond market performance of late. But I think it's important to try and think back to the scenario that we faced. It's event risk and one never knows what might prevail. But it's important to think in probabilities, and for us there was quite a strongly held consensus view that it would be a positive outcome, and really no one forecasted what actually came to fruition. And for us in those type of environments, we try to think independently, think critically about whether that's the appropriate probability to place on these type of events. And in our minds, it was much more appropriate to be a bit more defensive into this environment. We felt that there was increasing risk that the negative outcome might actually have happened. From the perspective of looking at the portfolios, it's simply being able to say, well, we'd be willing to give up a bit of upside to avoid the downside, because we think ultimately the more speed bumps you miss in fixed income, the better the outcome for the client.
So, I mean, perhaps a little bit of the local uncertainty has abated, but looking at the global environment, there's obviously a lot of challenges that remain, and perhaps one that looms the largest in most people's imagination right now is the outcome of the US elections in November. So, can you chat us through what some of those possible scenarios are?
Yeah, I think what's quite important to bring it back to markets is to think about the Fed and the interest rate cycle that we're seeing in the US, particularly inflation. There's a strongly held consensus view again offshore that inflation is gone, the US economy has slowed sufficiently, and the Fed can begin to cut interest rates. And we see a lot of investors sitting in overweight position in US bonds as well as the US equity. We think you should challenge the idea that inflation is gone. Simply looking at the data, inflation is not going to just fall from 4% to 2% and then stay there over the longer term. In fact, we think there's sufficient inflation pressure still in the economy. If you add the elections in, we look at Donald Trump and his campaign pledges, and we believe it's absolutely going to be more inflationary, both from an immigration perspective. It doesn't help solve the labor deficit in the US if you close the borders to immigrants. Tariffs will be something that we need to consider that will also be inflationary. And we do know that politicians will continue to spend more than they earn in tax revenue. So we do think we're in an environment where inflation will be sustained for the longer term at these higher levels. And from an investment perspective, we certainly don't think that inflation is gone and the Fed can commence on a deep cutting cycle.
So, Lyle, to summarize those views, I think what I hear you saying is that despite the election, it might not have as tangible an impact on US monetary policy as many people might expect. So, do you think that a continuation of the current scenario or the current factors that we see in play, do you think that that's priced into the market at the moment?
Well, I mean, if you're looking at the US market from an interest rate perspective, it's currently pricing for 3 interest rate cuts. The bond market, you can see the bond yield curve is inverted, so it's definitely saying, we think that interest rates should come down. And we think that's where the risk lies, because ultimately when we think about it from an inflation perspective, in our view, the Fed shouldn't cut. Will the Fed cut? They probably will. And we think when we're looking at the Fed now, they are quite aware of the fact that the US is facing a bit of a debt issue. They continue to spend more than they earn. Their interest bill has gone up by 75% in the last 2 years, and that's starting to accumulate. The only real way to solve that is to lower the cost of debt. But that has very big implications for how the cycle is playing out, because ultimately when you cut interest rates and your inflation is not under control, it's very negative for your currency. And so we think when you're looking at the dollar, although it's been on a 15-year upward cycle, we do think there's more impetus for it to weaken from here, and potentially what we are seeing is an inflection in the investment cycle.
So Lyle, when you look at an environment where locally we are seeing perhaps a bit more stability, and in offshore markets there is still a lot of uncertainty and many moving pieces, how do you weigh up the relative attractiveness of markets when it comes to constructing portfolios?
Yes, I think it's, in our minds, it's an environment where the probability is opened up, where you can have much better years in South African assets. And I think the first point would be, we do think the global cycle is turning in favor of emerging markets, and South Africa included, and that can have a very big impact in terms of flows that might enter the space. From a local perspective, certainly I think we are in a much better environment with the political premium that's been placed on our assets in recent years. We think in time that will begin to unwind. And we mustn't forget we are entering into an interest rate cycle, interest rate cutting cycle. And we think from that perspective, bond investors are set for very, very good returns in the fixed income space. So what we're doing from a portfolio perspective is, I mean, we obviously want to avoid the speed bumps, but we do think this is an environment where you can be a bit offensive on South African assets. And so we're definitely locking in the real interest rates available in our government bond space, but equally, in low risk bank funding instruments where we can lock in yields of 9 to 10% for 5 years out. And we think that's the right thing to do at the top of the cycle. And that means we can offer attractive yields long into the future, offering an inflation plus 3 type profile for investors in our PSG Diversified Income Fund.
Lyle, it's been great chatting to you. Thank you so much for taking the time and letting us in on some of those nuances of managing fixed income portfolios in the current environment.
Thank you, Audrey.
Thanks.